Hey everyone, welcome back to Corporate Decoder, the place where we unpack the financial secrets hidden in plain sight. In corporate filings, today's report from U.N.I.V.E.S.T Financial Corporation is a goldmine for anyone curious about how banks navigate today's economic landscape, especially after a period of rising interest rates. Let's dive into their latest quarterly report. So U.N.I.V.E.S.T Financial Corporation is out with their September 2025 quarterly report, and boy do they have some numbers to talk about. Let us first look at the big picture. Their balance sheet on the asset side, their cash and cash equivalents jumped significantly from about $329 million at the end of 2024 to over $816 million by September 2025. That is nearly a 150% increase. It's like they suddenly got a massive infusion of cash. A big part of that jump is in interest. Earning deposits with other banks soaring from around $253 million to over $745 million. This usually means they are holding on to more liquid funds, possibly waiting for better investment opportunities or preparing for potential deposit outflows. Now, for the core banking business, their loans and leases held for investment actually saw a slight dip, going from about $6.83 billion down to $6.79 billion. Not a huge drop, but worth noting, especially when combined with the cash increase. On the flip side, their allowance for credit losses on loans and leases also saw a small decrease from $87.1 million to $86.5 million. It's interesting that their reserves for potential loan defaults went down slightly, even as their overall loan book marginally decreased. This might suggest they feel more confident about the quality of their loans, or it could be a strategic adjustment. Moving over to the income statement, let's see how they raked in the dough. Their net interest income, which is the bread and butter for banks, showed a healthy increase. It was up by about $8.2 million or 15.4% for the 3-month period, and a substantial $22.3 million or 14.2% for the 9-month period. This tells us they are making more money on the spread between what they earn on loans and securities and what they pay out on deposits and borrowings. Interestingly, the provision for credit losses took a significant leap for the 9-month period, going from $3.6 million in 2024 to $8.5 million in 2025. This jump is largely due to a specific commercial loan relationship. This is a real red flag that something unusual is happening in their lending portfolio. Their other income streams also tell a story. While trust fees and investment advisory income grew steadily, other service fee income actually dropped quite a bit for the 9-month period. This seems to be related to mortgage servicing rights and gains on loan sales, suggesting a tougher market for those particular services. On the expense side, salaries, benefits, and commissions went up, which is pretty standard, especially when profitability increases. But what really stands out is the increase in other expenses, up 14.8% for the quarter, driven by a tax on bank shares and loan workout fees. This points directly back to that troubling commercial loan relationship we saw impacting the credit loss provision. Overall, their non-interest expenses went up by about 4.4% for the quarter and 2% for the 9 months, which is certainly something to watch as they grow. Despite the increased provision for credit losses and higher other expenses, their net income actually surged by 38% for the quarter, reaching $25.6 million, and showed a solid 19.3% increase for the 9-month period, hitting $68 million. This suggests that the core banking business is performing very strongly, especially with those higher interest rates on loans and securities. And that strong core performance is reflected in their net interest margin, which improved to 3.17% for the quarter and 3.15% for the 9 months, compared to 2.82% and 2.85%. In the prior year, it means they are effectively managing their interest, income, and expenses. Now let us talk about the not so good stuff, the non-performing assets. They ballooned from $33.2 million at the end of 2024 to over $52 million by September 2025. This huge jump is mostly tied to that one commercial loan that went bad and ended up transferring property to other real estate owned. Specifically, non-accrual loans and leases went from $12.7 million to $27.3 million. This is a significant increase and directly linked to that problem loan we discussed earlier. Even with that surge in non-accrual loans, their allowance for credit losses as a percentage of total loans stayed remarkably steady at 1.28%. This implies they believe their current reserves are sufficient even after that significant charge, off demonstrating a potentially stable lending environment for the majority of their portfolio, even with that one outlier. When we look at their commercial loans by industry, CRE retail makes up the largest chunk at 8.4%, followed by animal production and CRE multifamily. This indicates a diversified commercial loan book, but also exposure to sectors that can be sensitive to economic downturns. Even though most of their investments are in level 2, meaning their value is based on observable market data, their credit derivatives and contingent consideration liability rely on level 3 inputs. These are unobservable, meaning management's judgment plays a big role in valuation. This is where things get a bit fuzzy and a future risk if those judgments are off. Their capital ratios are looking really strong, both for the corporation and for the bank. They are well above the requirements to be considered well capitalized, meaning they have a good cushion of safety, especially with total capital for the corporation at over 14% of risk. Weighted assets, that is a very healthy number. So what is the story here? U.N.I.V.E.S.T Financial seems to be doing quite well on the core banking front, with strong net interest income and profit growth. Their deposit base is growing and their capital is solid, however, that's significant charge. Off and the subsequent increase in non-performing assets are worrying signs that highlights a concentration risk in their commercial lending portfolio that needs careful management. They seem to be managing this by having a robust allowance for credit losses. But it is definitely something to keep an eye on. The company is expanding its wealth management business, which is a good divers. Ification strategy away from pure lending, and they are maintaining a strong liquidity position by holding onto a lot of cash and having access to significant credit lines. Overall, UNIVEST is navigating the current financial landscape effectively. But that one large problem loan is a reminder that even managed institutions can face unexpected challenges. Their ability to absorb that loss and maintain strong capital ratios speaks volumes about their resilience. Alright, that is our breakdown of U.N.I.V.E.S.T Financial Corporation's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable hitting that. Like button really helps, and subscribe for more deep dives. Don't forget to check out our Discord in the description below. We talk more about these filings and other market insights there. Thanks for watching. See you next time.